Your mortgage might be paid off, but your home is still draining your bank account every single year. If you live in Florida, a silent crisis is brewing that could force you out of the retirement you earned, and the deadline to fix it is closing in fast. You did the responsible thing. You worked hard, you saved, and you paid off your house to ensure a secure retirement. But there is a leak in your financial plan that you didn't create. Property taxes, insurance premiums, and special assessments. While your income has switched to fixed, the cost of simply existing in your own home keeps climbing. Florida lawmakers are finally realizing that the current system is unsustainable for seniors, and they are debating massive changes right now ahead of the 2026 legislative session. Some of these proposals could save you thousands, while others might determine if you can afford to stay in Florida at all. But before we break down these 10 critical updates, do yourself a huge financial favor and subscribe to Tax Hack Pro right now. We track every dollar the government tries to take so you can keep more of what you earned. Now, let's dive into the 10 proposed changes that could save or sink your retirement. Number 1 is the proposal for a full local property tax exemption for seniors over 65. For thousands of Floridians, the greatest threat to their financial security isn't a stock market crash. It is the annual tax bill on a home they already own free and clear. You haven't added a pool or a new wing to the house, yet your tax burden grows every year because the market says your home is worth more. But market value doesn't put cash in your pocket to pay the tax collector. This specific proposal attempts to sever that tie. It suggests that if you are 65 or older, you would no longer pay any city or county taxes on your primary residence. You would still contribute to school taxes, but the municipal portion of your bill would drop to zero. This is about more than just saving money. It is about the dignity of aging in place. A home is a repository of memories, not just a line item on an asset sheet. By eliminating the local tax burden, the state would essentially be acknowledging that seniors have already paid their dues to the community's infrastructure over decades of working life. This shift recognizes that being pushed out of your family home because of a tax bill isn't just bad economics, it is a moral failure of the system. Number 2 is an income-based property tax elimination. This proposal tackles the house-rich, cash-poor dilemma head-on. Florida has seen property values explode post-pandemic, which looks great on a net worth statement, but is terrible for a fixed monthly budget. You cannot pay for groceries with your home's equity unless you sell it or go into debt. This legislation proposes that we stop taxing seniors based on the inflated value of their real estate and start looking at their actual ability to pay. If your household income falls below a specific threshold, your local property taxes would be drastically reduced or eliminated entirely. This is a targeted strike designed to protect the middle and lower income retirees who are most vulnerable to gentrification and inflation. It shifts the tax philosophy from "what is this land worth" to "can this person afford to stay here?" It creates a safety net, ensuring that a rising real estate market doesn't punish the very people who helped build the community. However, this will require vigilance. Unlike a blanket cut, this will likely require proof of income and annual filings, meaning you have to stay on top of the paperwork to get the benefit. Number 3 is the complete elimination of local property taxes on homesteads. This is the most aggressive proposal on the table, and it applies to everyone, not just seniors, though retirees would benefit the most. The concept is radical but simple. You should not have to rent your home from the government in perpetuity. This proposal suggests removing all city and county taxes for primary residences, leaving only school taxes in place. For a retiree, this converts a variable, rising expense into a significantly smaller, more predictable one. It removes the fear that a hot housing market will tax you out of your own living room. However, this is also the most controversial proposal because it forces a hard conversation about how we fund police, fire departments, and roads. If this passes, it fundamentally changes the definition of homeownership in Florida, making it a true asset rather than a continual liability. It signals a shift toward consumption taxes or other revenue streams, placing the burden on spending rather than on the security of your shelter. Number 4 is a gradual phase-out of property taxes over 10 years. If the state decides it cannot afford to cut taxes overnight, this is the compromise. This proposal suggests a 10-year glide path where the homestead exemption expands annually, slowly driving your local tax liability down to zero. Psychologically, this is huge for retirement planning. If you are 65 today, you can look at a 10-year horizon and know that your housing costs are scheduled to go down, not up. It flips the script on inflation. Instead of worrying about how you will afford your tax bill in 2030, you can plan for a future where that bill is negligible. It gives local governments a decade to adjust their budgets while giving homeowners a guaranteed light at the end of the tunnel. It replaces the anxiety of the unknown with a structured timeline for financial relief. Number 5 is expanded, Save Our Homes portability with no cap. Currently, many seniors feel trapped in homes that are too big for them because they are terrified of losing their tax benefits. Florida's Save Our Homes cap keeps your taxable value low, but if you move, you can only take a portion of those savings with you. There is a cap on portability. This proposal eliminates that cap. It would allow you to take every cent of your accumulated tax savings and apply it to a new homestead. This is a game changer for downsizing. It means you could move closer to the grandkids, move to a single-story home, or move to a cheaper area without the government hitting you with a massive tax hike for the privilege of moving. It unlocks the housing market, freeing up large family homes for younger buyers while allowing seniors to move into housing that fits their current physical and financial needs without a tax penalty. Number 6 is a property tax freeze for long-term homeowners. This rewards loyalty and longevity. The concept here is that if you have lived in your home for a set number of years, say 20 or 25 years, your assessment freezes. It stops moving. Even if a developer buys the house next door and builds a mansion, driving up comparable sales in the neighborhood, your tax value stays locked in time. This is critical for preventing gentrification from displacing the elderly. It acknowledges that you cannot control the market around you. Just because your neighborhood became trendy doesn't mean your pension doubled. This freeze ensures that your housing cost remains a known quantity for the rest of your life, protecting you from external market forces that currently dictate your tax bill. Number 7 is a lower cap on property tax assessment increases. Currently, there is a limit on how much your assessed value can go up each year, but over a decade, those small percentage increases compound into a massive bill. This proposal seeks to tighten that leash. By lowering the annual cap on assessment increases, the state would slow the rate of tax growth significantly. This is the power of compound interest working in your favor for once. A difference of even 1 or 2% in the cap can save you thousands of dollars over the span of your retirement. It acts as a brake on the tax system, ensuring that even when the real estate market is overheating, your tax bill remains cool and manageable. It aligns tax growth more closely with the cost of living adjustments seen in Social Security, rather than the volatile swings of the real estate market. Number 8 is a 25% additional homestead exemption. This is a straightforward tax cut. The proposal would allow homeowners to exempt an additional 25% of their home's assessed value from city and county taxes. It creates a larger buffer between the market value of your home and what the tax collector can actually touch. For seniors in modest homes, this could substantially lower the effective tax rate. It acts as a permanent shield, absorbing a quarter of the value fluctuation. It doesn't require complex income verification or long residency requirements. It simply expands the portion of your wealth that the local government is not allowed to tax. Number 9 is a $100,000 exemption for insured homes. This is a fascinating proposal because it ties taxes to the insurance crisis. Insurance premiums in Florida have skyrocketed, forcing many seniors to go without coverage, which puts their entire financial legacy at risk. This proposal offers a $100,000 reduction in assessed value specifically for homeowners who maintain qualifying insurance. It operates almost like a subsidy. The state is effectively saying, if you pay for insurance to protect your asset, we will lower your taxes to help offset that cost. It incentivizes responsibility and helps safety-proof the community against hurricanes and disasters. For retirees struggling to pay insurance premiums, this tax break could be the difference between keeping their policy and rolling the dice on being uninsured. Number 10 is increased exemptions for widows, the blind, and the disabled. The current exemptions for these groups have not kept pace with inflation. A $500 exemption might have meant something in 1990, but today it is a rounding error on a tax bill. This proposal seeks to modernize these numbers, raising the exemption amounts to reflect current economic realities. For a widow whose household income has been slashed in half, or a senior managing disability costs, every dollar counts. This isn't just about tax policy, it's about compassion. It updates the safety net to ensure that the most vulnerable homeowners aren't being pushed toward foreclosure because the tax code is stuck in the past. The takeaway here is not just hope, it is preparation. These ideas are moving through the legislative pipeline right now. The window to influence these decisions and prepare your estate for 2026 is open, but it won't stay open forever. You need to know which of these you qualify for and how to apply the moment they become law. To stay ahead of these changes, make sure you are subscribed to Tax Hack Pro. We will keep you updated on every vote and every form you need to file. Don't let the system change without you. I'll see you in the next video.